Welcome. We're witnessing a profound structural shift in the global gold market, with behaviors that are challenging decades of established financial models. Today, we're going to conduct a rigorous analysis of the forces driving this change and explore whether we have truly entered a new paradigm for gold.
So this brings us to the central question confronting analysts today. Why is gold showing such persistent strength in an environment of high real interest rates? This dynamic, as you know, directly contradicts the established playbook. For decades, the relationship was simple. When real rates went up, gold went down. That this relationship has broken is the core of our analysis.
Our thesis is that the current bull market is not merely a cyclical phenomenon, but a fundamental paradigm shift. It rests on three core pillars. First, what we're calling the Great Decoupling, a structural break from gold's historical relationship with interest rates. Second, new structural supports are in place, primarily deep-seated concerns over U.S. sovereign debt. And third, a highly resilient demand structure, which we'll refer to as the modern demand trinity.
Now, to really appreciate the scale of this shift, we first have to establish a baseline. Let's examine the consistent patterns that defined gold's past bear markets. These were the old rules of the game.
As you can see from the data, a very clear macroeconomic blueprint emerges. In every major bear market cycle since the 1970s, two conditions were consistently met. Real interest rates rose and the US dollar strengthened. The logic was inescapable. The opportunity cost of holding a zero-yield asset like gold simply became too high. That was the predictable historical playbook.
And this timeline really just reinforces that cyclical nature. Each of these distinct periods, whether it was the Volcker shock to crush inflation or the Fed's taper tantrum, triggered that same mechanical response of higher real yields and a stronger dollar, which in turn led to a decline in the gold price.
All right, now let's pivot to the current market, where that historical playbook has been effectively discarded. We need to dissect the core anomaly here, gold's pronounced deviation from its traditional drivers.
And here it is. This chart illustrates the fundamental break. Since late 2022, we've seen a simultaneous rise in both gold prices and U.S. real yields. This positive correlation is frankly unprecedented in the modern era and signals that the old model is no longer the primary determinant of price.
This phenomenon is what we're calling the Great Decoupling. And what it suggests is that investors are now prioritizing an entirely new set of factors that outweigh the traditional calculation of opportunity cost when they allocate capital to gold.
So, if real rates are no longer in the driver's seat, what is? Well, two interconnected macro narratives have emerged to replace them as the primary structural supports for this new gold paradigm.
The first pillar is the U.S. fiscal situation. With the national debt now exceeding 120% of GDP, the market's focus has begun to pivot. The conversation is shifting away from the yield on U.S. assets to the long-term credit risk of those assets. This is a critical distinction.
The second pillar is the historic level of buying from the official sector. We're talking about annual net purchases by global central banks exceeding 1,000 tons since 2022. This isn't speculation. This is a clear strategic policy of diversification away from the U.S. dollar as the primary reserve asset.
And this quote really captures the essence of the shift. Gold is being reevaluated. It's no longer just being viewed as a zero-yield asset in a world of positive-yielding bonds. Instead, it's being priced as a primary hedge against the perceived long-term risks inherent in the reserve currency itself.
And this new mindset is supported by what we're calling the modern demand trinity. You see, unlike past cycles that were often dominated by a single class of investor, today's market is supported by three distinct and highly motivated buyer segments: strategic central banks, tactical institutional hedgers, and value-preserving Eastern retail buyers. This diversity provides an unprecedented level of structural resilience.
Okay, so with this new framework established, we can now assess exactly why the historical triggers for a bear market in gold are proving to be so ineffective in the current environment.
Let's do a direct comparison. In the past, aggressive Fed tightening was a primary bear catalyst. Today, that policy is heavily constrained by the sheer size of the national debt. Structural dollar strength used to be a headwind. Now it's being counteracted by a global de-dollarization trend. Central banks were once net sellers. Today they are buying at a record pace. You see the pattern here? Every major catalyst for past bear markets is either absent or is inverted into a powerful tailwind.
So looking ahead, the path for gold will likely be determined by the evolution of these core macroeconomic and geopolitical conditions. For example, a hard landing in the U.S. economy that forces aggressive easing could certainly act as an upside catalyst.
Conversely, the key downside risk could be an unexpected productivity surge that gives the Fed room for a new hiking cycle.
To put it plainly, the core logic has changed. The primary risk that gold is being used to hedge is no longer simply near-term inflation, but rather a more fundamental, deep-seated concern over long-term sovereign solvency.
And this leaves us with a final, critical question for all market observers. Is it possible that gold's price is no longer a simple reflection of the dollar's current strength, but is instead becoming a referendum on its future? That is the central question as we navigate this new and very different era for gold.